Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the weekend edition of the KE Report. Corey and Shaddy here, your hosts for this weekend show, also your hosts on our website, podcast, YouTube channel, and Substack page. Just search the KE Report. That's where you can hear the full weekend show as well as all our market updates throughout the week covering market moves and economic data as well as company updates, which again, it's been a very busy summer. A lot of companies out there doing stuff. A lot to follow up in, especially in the commodities sector, and that's the focus of this weekend show. We're going to be focusing on more the metals in the first half of the show as we're chatting with Rick Rule, and in the second half of the show, moving over to the energy sector, oil and natural gas with Joseph Schachter. A lot of good information coming on this weekend show for all of you, the active investors in the resource space. Without further ado, Rick, welcome back to the show. Rick is the founder of Rule Investment Media and the founder of Battle Bank. Rick, I want to start off more broadly discussing this commodities bull market. I don't think anyone can argue that we are in a commodities bull market. We've seen gold do well. We've seen base metals do well, and we've seen some of the other smaller metals also do pretty well. But again, when you have gold and copper doing well, that really carries a lot of commodities. It's actually been energy that's been slow, but focusing mostly on metals, gold bottomed back in late 2015 at around $1,000. It's been going up for pretty much 10 years. Key breakout happened last year in 2024. And copper, it's broadly, I think, revalued post-COVID into a much higher trading range. So, Rick, what can you say about this commodities bull market?
I would say importantly that it's two bull markets. There is a precious metals bull market, which I think has different fundamentals than the commodities bull market. I think the commodities bull market is also more vulnerable, as the energy complex price quotes would suggest. More challenged because the commodities market itself is very vulnerable to a global economic slowdown. I'm not suggesting we're going to have one, Corey. And I would suggest that we will, in the next 10 years, experience a commodities bull market that will likely take investors' heads off. I mean, a really explosive commodities bull market, really around supply shortages, themselves a consequence of 3 decades of underinvestment in commodities. I think the bull market in precious metals, however, is already underway. And I think the underpinnings of the precious metals bull market are different from the underpinnings of the commodities bull market, in the sense that, in my experience, precious metals bull markets are first and foremost a reflection of investors and savers' fear around the maintenance of their purchasing power in fiat currency denominated instruments, particularly, including on a global basis, the US dollar. The United States is still the domicile of 23% of the world's investable funds. And around the world for 40 years, the US 10-year Treasury has been the bottom line, baseline savings product. And I think the impact of the debt and the deficit and the unsecured entitlement obligations of the US government relative to the size of the federal budget and relative to the size of the US economy, which is the ultimate payor, suggests that fear in the maintenance of the purchasing power of the US dollar is well funded. I believe myself, Corey, that the purchasing power of the US dollar will decline in absolute terms. I say absolute, meaning not relative to the Canadian dollar or the euro, but in absolute terms. I suspect that the decline in the US dollar purchasing power over 10 years will be 75%, which is to suggest that $4,000 worth of goods and services today, or put differently, $4,000 today in 10 years will buy you $1,000 worth of constant priced goods and services. And I think really the increase that we've seen in the gold price is a reflection of that. And I'm afraid to say that I think that that increase will continue. That doesn't mean that it'll be stair steps to heaven. I think in the very, very near term, Corey, that the anti-US dollar trade is a crowded trade. Everybody is in it. Even, and I hate to say even, but even the Canadian dollar has outperformed the US dollar on a 12-month basis. But I would suspect, given the challenges that the US dollar faces, that, as I say, over a decade, we lose a lot of purchasing power. Now, when I describe the trade as being overcrowded, I'm talking about in the very near term. And it's important to caveat my caveat by saying if the US Treasury caves into the president and artificially reduces US interest rates, that will be a signal to savers and investors worldwide that US society has no interest in the integrity of the US dollar. If we see that happen, all bets are off with regards to lots of financial markets and the gold market.
Well, Rick, I think the point you make is very germane that a lot of times people look at the dollar index in relation to other floating, equally troubled fiat currencies and look at where the dollar's trading and look at the trend there. But really, the lack of purchasing power over time is far more germane. And that's not really what's happening in the dollar index. That's what your dollars can buy. And if it's going to be a 75% haircut over the next 10 years, then that just means everything else has to go up in price. Now, we have seen gold reflect that for quite some time. I mean, it was $35. Now it's $3,400, almost $3,500. It hasn't changed. Gold's still a rock. It's still on the elemental table. But the price of gold right now has been great for the gold producers, and the price of silver playing along, up in the mid 38s as we talk. So definitely at a high level historically. When you look at how the sector has developed this year, it's been one of the standout sectors, the precious metals equities along with the metals. Any thoughts on how you've seen the producers responding to Q1 and Q2 earnings? Are we seeing more generalists in the space? And does that bode well for the juniors to keep running along for the ride?
Let's do those questions backwards because you asked me a bunch of them. I am not seeing generalist investors in the precious metal space yet, which is great news for gold bugs. The market share in the US market of precious metals and precious metals related securities is about 0.5%, which is to say that 0.5% of savings and investment assets in the biggest single investment market in the world are oriented towards precious metals. Importantly, the 4-decade mean, according to JP Morgan Chase, actually now 45-year mean market share is 2%. So if the generalist investors come into the space, even to the extent that we return to mean, it suggests that there's room for a fourfold increase in demand for precious metals and precious metals related securities. That is to say that the bull market that we've enjoyed has been a bull market that hasn't taken place as a consequence of the generalist investor coming into our space. This bull market is a textbook bull market in the sense that the first part of the bull market, let's call it the period 2020 to 2022, 2023, was really a dead cat bounce. Gold itself had underperformed and was catching up. The breakout period, as you correctly suggest, occurred in 2023, and the increase in the gold price in 2023 was mirrored by an increase in the production costs around gold and silver. And the consequence of that was that the increase in the gold price didn't increase producers' margins at as fast a rate as people had hoped it would. People, you may recall, were concerned about the fact that the gold price increased, but the gold shares hadn't increased. And that was partially a function of the fact that margins didn't increase, at least concomitant with the increase in the gold price. By 2024, the increase in the gold price had gone on for long enough and had continued to high enough levels that the higher gold price really dramatically increased the cash margins of the biggest and best producers, the hallmark, of course, being Agnico Eagle. And the consequence of that is that leadership in the market changed from the metal itself to the best of the best producers. This has happened in the last 3 bull markets, precious metals bull markets in my life. And one can reasonably expect market leadership to go from the best of the best to the best of the rest, to the leveraged plays, to the single asset producers, to the developers, and ultimately to the explorers. One thing that's interesting here is that even without the participation of the generalist investor, enough cash is cascading down the quality trail that the high quality juniors who are going out to raise money, and they're going out to raise money like mad, are raising all they need. There is, of course, a discrepancy in the junior market between the high quality juniors and most juniors. Given that most juniors have a net present value, not a market cap, but a net present value of zero, those companies are continuing to have problems raising money. But the companies that deserve to get money have seen a very, very, very different capital markets experience in the last 18 months, and that continues.
Rick, I'd say even in the last about 3 months, we have seen, I think, even more money filtered down the food chain. Some of these companies that haven't had news for years seem to be able to raise money even right now. And it's one of those things where gold price has gone sideways for about 5 months now, and the stocks have played a lot of catch up. I'm sure you hear the same stuff where, look, these stocks are all cheap. We keep hearing how cheap these stocks are, but quite frankly, we have seen a revaluation almost across the board from the big guys to the little guys, especially the little guys in the last few months. But in terms of class of companies within the precious metals, where do you still see the best value now that we have had this catch-up trade?
I think you have to be selective. I don't do it, but one place that we're seeing value is companies that have fairly long reserve lives and mines built so that they won't experience the inflation in mine builds, that are selling at low multiples to the net present value of free cash flow, so-called optionality companies. Companies that I have avoided because they aren't in the best half of the cost curve. So I'm thinking companies like Oceana Gold, with 15, 16% free cash margins, long reserve lives, the construction budget behind them. I'm seeing value there. I'm seeing value in the smaller end of the royalty and streaming space, relative value at least. You're seeing the biggest and the best, the Francos and the Wheatons, performing spectacularly well and selling at a premium to ascribed net asset value. You come down the quality trail just a little bit, to the Osiskos, the Triple Flags, those companies. They're selling at substantial discounts on a net present value basis to the big guys. If those valuation discrepancies don't disappear due to value arbitrageurs, make no mistake, the big guys will take over the little guys. And the valuation discrepancies coming down are even more extreme, which is why you saw the Sandstorm recently disappear. So I'm attracted to that. When you come to the quasi-royalty companies, I'm thinking about the prospect generators that rather than taking carried working interest, take royalties. You're seeing at least two of them, Altius and EMX royalties, selling at extraordinary enough discounts to the net present value of their assets that rather than issuing shares to raise money, they're using their own free cash flow to buy in shares. I would suggest as an example that EMX is selling for half the market cap that the valuation of the sum of the parts at auction would face. And the EMX management, I think, has decided that the best way to increase net asset value per share, rather than making new investments on the opportunities on offer, are simply buying in their own shares. And I think Altius, with the recent sale of the Walker Lane royalty, has made the same decision. One thing, Corey, that has always amused me is the old Doug Casey quote, which describes the return of capital to shareholders via dividends or buybacks for those companies who can afford it as, quote, outward manifestations of inward grace. And Doug suggested that sometimes in the market, you have a choice between buying companies who are issuing shares, believing that your cash has more value than their shares, and other companies who are using their cash to buy your shares back, believing the shares are more valuable than the cash. One real determinant of a company's real worth is whether it's issuing shares or buying back shares. And I would urge people to look past the narrative and think about that.
Well, Rick, you bring up a great point about as far as how companies are choosing to return capital. Some are buying back shares, some are paying dividends in the producers and even in the royalty space. But the other area that they could invest that would be into growth, organic growth, but also M&A. And so you brought up M&A with Sandstorm being taken over by Royal Gold and how that's taken another one off the board. But do you think we'll see more M&A coming out of this Beaver Creek Denver Gold Forum cycle in about a month and a couple of weeks here, where some of the development stage companies get gobbled up by mid-tiers, or some of the producing single asset producers get picked off? Are we going to see an increase to the M&A that we've already been seeing?
Absolutely. If the valuation discrepancies continue to exist, yes. What we're seeing is reasonable quality deposits at the preliminary economic assessment stage, which is to say where the information presented to us is incomplete and where the timeline to completion is 5 years or longer. We're seeing those companies sell at about 20% of indicated NAV. As the timelines shorten and we go to pre-feasibility study, the discounts are more like 40 or 45% of NAV. At the bankable feasibility stage, those assets might be 75% of NAV. Combined into a single asset producer, that project may be 1.1 times NAV. Combined into a multi-asset producer, particularly a multi-asset producer in a jurisdiction that's perceived as being politically safe. You'll notice I said perceived. The NAV multiple may be 1.5 or 1.6 times NAV. To the extent that those valuation discrepancies persist, I think it makes absolute sense that larger, more liquid companies with lower cost of capital, which is to say a less of a discount or a negative discount to NAV, will take over the other companies. It will be cheaper to purchase at a premium successful efforts using your own stock where you have a lower cost of capital than your competitors do.
Yeah, that strategy makes all the sense in the world just because, well, we've seen how tough it is to build mines. That actually ties into another question. Curious your thoughts on these juniors or mid-tiers that are taking over these old mines, these mines that have bankrupted one, maybe a few companies, but these mines are making money right now. And it's in a way re-rating some of these juniors, but they're no way in the lower quartile of costs. What do you think of this strategy and some of these plays?
I don't think that you can paint all of them with the same brush. I think to the extent that a junior is taking over a producing mine, that you need to look at the management team's track record doing exactly that. An example would be Tony McCooch at Discovery, taking over some of the Ontario assets of Newmont. What he is doing is signing up to a task which he has done for 30 years. It makes perfect sense that that asset wasn't germane to Newmont and that that asset was used as a cash cow to fund other Newmont opportunities, and it didn't get the love, care, and attention in Denver that it might. It's arguable that Tony McCooch will be able to selectively invest capital in that mine that Newmont didn't invest, and that mine will be his focus. And he has focused on the Abitibi and the Canadian Shield his entire career. That type of acquisition makes sense. A different type of acquisition, where people are adding assets merely for scale, where they don't have the demonstrated ability to turn the asset around, I think is more problematic. So I think that you need to examine the companies involved in those transactions on a case-by-case basis.
Well, Rick, we've also seen a couple of roll-ups in the silver space. I'm thinking of Gatos by First Majestic, Silvercrest by Core Mining, and Mag Silver by Pan American. That takes a lot of the quality off the table and merges it into larger companies, but there's still a rabid interest in silver production. Unfortunately, most silver producers are base metals producers or gold and silver producers. Hard to find that isolated silver-only producer. In that universe, do you see any opportunities in the producers or developers within the silver spectrum?
Yeah, I do. This is my fourth precious metals bull market. And at some point in time, the generalist investor comes into the precious metal space. The price momentum justifies the narrative, and people who are investors in other space come into our space. When that happens, I don't know why it happens, but when that happens, leadership goes from gold to silver and from gold stocks to silver stocks. And these things re-rate in absolutely crazy fashion. There simply isn't enough of a silo in decent quality juniors to accept the money that comes in the space. And they go absolutely berserk. There's a very small population of high quality juniors. I would suggest that, well, in the producing space, likely Aya, albeit based on current production, it's fully priced based on its pipeline and its track record, likely not. And then Abra and Wisla. That's a fairly small universe. There are probably some other names, but those are the ones that I'm intimately familiar with. And when the generalist money comes down into the precious metal space, if past is prologue, the silver stocks explode, even the lousy silver stocks. But I wouldn't encourage people to buy lousy stocks as a consequence of people even dumber than them coming down into the space. Looking at the acquisitions that have taken place, a couple of them are easy to explain. In the case of, both Core and First Majestic, while they have long track records buying and turning around mines, both of them were, at least in the near term, cash flow deficient. And both of them bought assets that were very accretive to shareholders on a per share cash flow basis. This occurred because both of the assets that they bought, Gatos and Silvercrest, have relatively short indicated mine lives, which means that the cash flow overstates the net present value. Now, I happen to believe in both cases that there's exploration upside. In other words, that these mine lives can be extended. But based on the data, those two transactions were similar. The transactions were accretive on a cash flow per share basis, but they were not accretive on a net present value basis. The acquisition by Pan American of MAG was the acquisition of a uniquely high quality asset at a premium price by a premium issuer.
Interesting breakdown there, Rick. Let's also switch our focus over to copper. Look, copper, I think, has completely re-rated post-COVID. Seems to have a floor right around $4 a pound and a ceiling, well, right now in the $5 and change region. But taking out that tariff spike, copper has kind of been trading in a trading range with a slight upward bias for the last about 3 years. And more recently, the stocks have started to do a bit better. What do you see in the copper space in terms of opportunities?
In the very near term, I'd be scared. Copper is an economically sensitive commodity, and the weakness I see in the oil and gas quote, by the way, I'm really attracted to the oil and gas business. The weakness I see in the oil and gas quote, I'm very afraid is going to cascade into the copper market. So in the very near term, I'm nervous about that trade for economic reasons. Looking longer term, there's zero doubt in my mind that we're going to have supply shortages in copper. We have underinvested in the copper industry for at least 3 decades. Underinvested in exploration, underinvested in sustaining capital, and those chickens are going to come home to roost. The deterioration in the purchasing power of the US dollar that I described is going to raise the price of building new copper mines from high to astronomical, to the extent that you're going to spend $8 billion to build a Chilean porphyry in 2025 dollars. I'm relatively confident that 3 years out, that number will double. So the value of existing producing assets that don't need to be built from scratch is, I think, unrealistically cheap. I believe that you will see financing mechanisms developed over the next 10 years, including, as an example, term contracts in copper, like the term contracts in uranium, that will overcome some of the financial challenges. So the higher quality copper discoveries, I think, will do well too. But I would be very concerned in the near term for speculators that have a trader's mentality, for people who are looking for, how would you say, capital gains by Christmas. I'd be very concerned about that. I'm happy in the copper space myself because I have a 5-year outlook, but I've come to realize that I'm a different type of speculator. I would note too, Corey, around the whole speculative complex near term, including the speculative gold stocks, that the VIX, the volatility index, is at almost all-time lows, which suggests that there's no fear in the current market. And if you saw the VIX tick up to 20 and you went back to a risk-off trade, even temporarily, you would see in the very near term the juniors getting waxed. I'm not saying that's going to happen, but I'm saying that speculators, that traders, need to keep that thought in the back of their mind.
Well, Rick, one more follow-up on the copper stocks. You've mentioned your propensity to invest in prospect generators, and when you're going after a copper porphyry, the holes are deep and they're expensive, and a lot of juniors try to do it and then fall on their face because they can only drill a few holes and then run out of money and get stuck on the hamster wheel. Do you prefer the prospect generator model for the exploration of copper porphyries and these kind of systems, or a partnership or a JV with a senior versus a junior going it alone?
Absolutely, positively. I prefer the prospect generator, period, full stop, irrespective of the commodity. The truth is, aside from the narrative, that most exploration efforts fail. When I was in university, I learned that 1 in 3,000 mineralized anomalies becomes a mine. So the basic Howe Street value proposition is that you'll have a 1 in 3,000 chance for a 10 to 1 return. Makes the BC lottery look like a good deal. The idea that your exploration methodology is to use your generative and commercial skills to formulate theses which are then tested with other people's money and other people's talents is arithmetically the finest form of exploration finance. In addition, you get off-balance sheet benefits. Not too long ago, I walked through the tech offices in Vancouver, and I was delighted to see about 200 earth scientists. The idea that I generate a prospect, which then tech explores, means I have access to those 200 earth scientists, and I don't pay for them. Tech does. So in every way, shape, or form, I prefer the prospect generator to any other kind of exploration finance technology.
Hey, it totally makes sense considering just how expensive it is to explore for copper projects and then also how big of a prize it can be. Rick, thank you so much for your time. I know you are a busy man, so it is great that you spent some time with us on this weekend show to share your thoughts on more of the metals sector. Another offer that Rick has for all of you is he is willing to grade your portfolio. I'll post a link to the Rule Investment Media website. That's where you can get in touch with Rick and share the stocks you hold in your portfolio, and he'll tell you what's good, what he doesn't like, and maybe anything else of wisdom, points of wisdom that Rick can share with you. So Rick, again, great having you on this weekend show. I hope you have a great rest of your weekend.
Gentlemen, thank you for inviting me back. I look forward to visiting again.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. Now shifting our focus over to the oil, natural gas sector, old school energy, as we're chatting with Joseph Schachter. Joseph is the founder and editor of the Schachter Energy Report, also writes the Eye on Energy Report on Substack. I'll post a couple of links in the show notes where you can follow along with Joseph's reports and get the rundown on what's happening in the oil and gas prices, as well as the companies that Joseph follows. Joseph, let's start with oil. I don't know how long we're actually going to stick on oil, the underlying price, because quite frankly, it's continuing to be pretty boring. We're recording this earlier in the week on Tuesday. Oil price right around $63 a barrel. It's been here for a couple weeks, and quite frankly, seems to have established almost a lower trading range, peak being around $70 a barrel and the floor being a little under $60 a barrel. Joseph, what do you think? What's going to drive oil here? Could we be seeing higher prices, or is this just a market stuck in kind of limbo right now?
Yeah, I think the higher prices will have to wait for winter. Demand picks up from the shoulder season. Again, this week's data from the EIA on Wednesday. Next week's EIA data will be the September long weekend, so people will be driving. But after that, we get back to what we call the quiet period in between, where you have in the spring slowdown and in the fall you have a slowdown, and demand falls by 1.5 million to 2 million barrels from the summer peak and then from the winter peak. So I think we're going to see, if we have a moderate winter, we're going to see 75, $80 pricing. But in the meantime, what I'd be watching is once we get into early September, if we start seeing inventory builds, 5, 10 million barrels a day, or sorry, 5, 10 million barrels a week, I think we're going to see a breach of $60. I think we've talked about that in April when I started watching the shoulder season again, the spring one, where I thought we were going to see big build in inventory, which did occur, and then we saw the low in April in the mid 50s. I think we're going to go back below 60, maybe 57 to 59 sometime in October, and that will give us another buy signal, just like we got in April, which was a table pounding buy signal. I think we're looking at something like that in October. The index would be in the 230s, the S&P TSX Energy Index, 57 to 59 on the price of oil. And I think you'll find bargains galore. And if the bullish percentage index is under 10%, we will be sending out action alerts with a lot of recommendations for buys. And I think people should be doing their homework now. Look at the Q2 numbers. We're going to be reviewing the Q2 numbers of the companies with good results on our webinar on Thursday night. And so people can go into the archives afterwards, become subscribers, and they can listen to the webinar. But the webinar is really a feature that we do once a quarter, which gives a chance for us to go over what we see as the highlights. And then we have 2 Q&A sessions where people can ask questions and we cover stories that they're interested in. And many of them send us the inquiries beforehand. And then I have one-on-one chats with management so that I'm updated as fully as possible to answer their questions. So bottom line is near-term lower oil prices below 60. Once we get into winter, 70 handle is there. And I think we could see 75, 80 before year end. And then if the winter in 26, a part of it, February is cold, we could pounce between 75 and 80. So I think we're heading in the right direction after this shoulder season.
All right, folks. So you heard it here. Definitely click on the link below in the show notes and subscribe to Joseph's service to get access to that webinar where they dig into the companies that did well in Q2 and some of the companies you want to put on your watch list and do more due diligence on. So if we see oil pull back into the high 50s, like you say, it could be a table pounding buy at that point, especially if you expect higher prices towards the winter. Let's also just broaden the oil discussion briefly, Joseph, out to internationally, because we hear that countries like Saudi Arabia and, when you look at OPEC Plus, that some of them wanted to ramp up production specifically just to squeeze out some of the U.S. frackers and some of the U.S. production. When you look internationally, any companies that surprise you with their output, or what do you think the lay of the land is as far as the global oil output?
Well, you remember that OPEC said that they were going to increase production in the month of May, June, July by 411,000. I think August 458, and then September over 500,000. They have increased quota, not real volumes. I'll just read I have the OPEC report in front of me, and in the month of July, they increased production by 263,000 to 27.5 million. But there were 2 countries that made the big part of the increase. Saudi Arabia went from 9.35 million to 9.53, and UAE went from 3.06 to 3.17, up 109, and then Saudi Arabia was up 170. But at the same time, you had Iraq down 51,000 to 3.9, and you had Iran down 12,000 to 3.25, and Kazakhstan was down. They're not an OPEC member. And surprise, surprise, China doesn't care what the Americans say about purchasing from Russia. Russia's production in the month of July went up 98,000 to 9.12. Their high water mark was 9.6. So they're not far, from, if the latest thing, the reason why we're down so much with oil prices today is Trump is now talking that he could use the stick or the carrot. The stick is more sanctions, more third-party sanctions against buyers of Russian oil, as you may have heard, and that's why we had a buck down on Monday. Today, the stuff coming out of the Trump administration, which changes from day to day, as we all know, 180 degrees this time. They're talking now that they want to see American companies like ExxonMobil come back to Sakhalin Island, that they buy American, equipment for exporting LNG, that they buy other American equipment. So Trump is on the marketing side of the business part of oil, and he's using that as a carrot with Putin versus before using the stick, which was what, the neocons want. And I think that incentivizing Putin will be a lot more successful than threatening him with the big stick.
Joseph, just a question regarding the OPEC plus countries. They seem to want to talk the market in a certain direction, but their production numbers consistently don't follow through, especially when they raise those quotas. Why is that? Can they simply just not produce as much as they would like to think, or is it just not profitable enough for them to do that?
Well, I think there's two issues. One, some countries, like I'll give you an example, Iran, their country was militarily was demolished, so they need all the cash they can get. So they sell to China and India, and all the money that comes in, barely keeps the economy going. So there's lots of problems there. Iraq has economic problems that are pretty serious. You go to Algeria, they haven't allowed any companies to come in there to drill. So you've got, government oil companies that are ineffective and not doing anything. You go to, countries like Kuwait, no spending on that. It's all spending on the government and largesse for the wealthy there. Nigeria always seems to have problems with, stealing of oil and, government having problems, getting the oil to market. And then, of course, you one after another. I think that the assumption here of the amount of production that can come on is just not there. And, even if we get, $80 or $90 oil, it will take some time for these countries to even wake up to the fact that they want to increase their production. I bring up one more thing from the EIA report last week. These prices, 63, 64, just don't work even in the US system. If you go to the Federal Reserve of Dallas, they talk about needing high 60s to mid 70s to justify a rate of return that's acceptable at a minimum return. And last week we had the data come out, and the production was 13.38 million, down from 13.4 a year ago. So we're producing in the States crude oil 18,000 below a year ago. That's a big negative, so the Americans need to, Trump wants cheap prices for, consumers to have cheap prices, but the industry can't make money at these prices. And so, they're not even going after their tier one inventory. They're cutting back budgets. You talk to anybody in the industry, in the service industry, there are rigs stacked up everywhere. Same thing with frac units. And so until the price of oil gets in the mid 70s, I don't think you're going to see much activity. Companies are going to take whatever cash flow comes in, pay down debt if that's a problem. And many of them have shareholder return issues where they're active buying back stock or they're paying dividends. And, they're listening to shareholders saying, don't spend money drilling more wells. We don't need that. Do it only when the price is incentivizing you to do that.
Yeah, so much for drill, baby, drill in this administration. And I don't know that the comments from Trump about wanting lower oil prices instilled a lot of confidence from the producers to grow and put more rigs on there. And neither is the price. And that was kind of the point with the OPEC Plus move to up production, was they wanted to squeeze U.S. producers. But let's shift the discussion over to nat gas. Talk about another sector that's languishing. Nat gas prices on the NYMEX below $3 now at 270 at the time of this recording, and not doing so great on the AECO either in Canada. So what's your outlook for nat gas, Joseph?
Well, we're sitting now with, of course, a warmer winter than people had expected. So I think that's the first part of it, is we need to have a moderate or a normal or a cold winter. That draws down right away a lot of volume. The other one, of course, is there's more LNG plants coming on, new trains coming on before year end, which will add a few BCF a day of draw. So I think that's going to be a big help. So between winter and LNG exports, I think we may have a good market during the winter of 25, 26. The question is, how big of a draw do you have? Do you bring storage down to 1.5 TCF? And if that's the case at the end of winter, then prices will be firmer in 2026 in the spring and summer because they'll have to fill storage. That's, just look what's going on in Europe. They had drained the storage more in winter of last year. So they've been paying a lot to fill storage with LNG. And that's why you have $15, $16 prices in Europe, is because they're desperate to make sure that they have enough gas for next winter. And, if we start seeing, big drawdowns in the States because of weather and data centers and exports via LNG, I think that's going to set the stage for a pretty dynamic natural gas market. But that might take into mid 2026 at the worst. If the winter is not cold, if the winter is cold, it could happen this winter.
So, Joseph, we covered the oil and natural gas sector last weekend show, more with the focus in the U.S. too. And the one thing that really stuck out to me is the increased rig count in the U.S. and what that usually leads to in terms of more supply in the near term, which to me really says that the natural gas price could still be under pressure, kind of what you're expecting into next year. What are we seeing in Canada, though? Are we seeing more drilling for natural gas like we are seeing in the U.S.?
Yeah, let me go through the Baker Hughes data for last week. So U.S. total rig count last week was down 8%. So 538 rigs working versus 585. And as you said, gas rig count in the States is up 122 versus 97. I think a lot of that is in Pennsylvania, where, President Trump went, and they're talking about more data center growth and big LNG usage. So I think that was part of it. But, I think the Permian also, people are drilling more gassy wells so to get the oil. Count in the States was 411, down from 483, down 14.9%. So $63, $64 oil definitely impacts the drilling activity for energy in the States on the liquid side. Going to Canada, the rig count was 56 for gas, down from 66, so down 15.2. So dry gas is definitely not being drilled. The liquids-rich Condi wells are being drilled. And the oil rig count, 123 versus 153, down 19.6. So even though you have the TMX pipeline with $63 oil, even with a 1.39 Canadian dollar, companies are saying, hey, maybe the economics are not as attractive. Let's wait and see if we can get $75 oil. And in the meantime, keep our balance sheets strong, keep the banks not worrying about us. And if we have a shareholder incentive plan, let's keep on doing that so we keep the shareholders happy. So, companies like InPlay and Petrus and Hemisphere continue to pay regular dividends. And in some cases, companies with strong balance sheets like Hemisphere, have paid 2 special dividends this year. Don Simmons and his team have done a fabulous job there. So I think what you need to do is just, do company by company. And we'll be talking about the ones who did the best. And I think we have 6 companies that we're profiling on the webinar, everything from a big company like Tourmaline down to a small company like Hemisphere, but ones that are doing very, very well. And we have one service stock which is doing extremely well. So we're going to bring them up and just say, here's the story, here's why we like them, and here's what we think is a great price to buy them at. So, as you see with our research, that's an important thing. Clients want to know, where is the price of bargain? Where could it be a year from now? And where could it be in the top of the cycle? And we're still in the early stages. And you can see that by companies saying that they trade below PDP, proved developed producing assets, which, means you don't have to drill another penny worth, and there's more money in the PDP than the stock price. And then you go in the top of the stock market when things are frothy, and 2014 was really the last time that was the case. You had companies trading over 2p. So they were willing to pay for proven reserves and probable reserves, and because they saw exploration upside, so they were willing to pay for more than 2p. So that's the cycle I see going into the end of this decade, and that's why I'm bullish. And what we say to people is, buy on weakness. Every time you get a bargain when they get oversold, buy and build your positions. And before the end of the cycle, we may see 3, 4, 5 baggers across the board on the E&P sector, and that's what you're looking for. And also takeouts where companies, will be, merging because it might be cheaper to buy barrels on Wall Street and Bay Street than it is to go and drill them up. So we've seen that at market tops before. I think we're going to see it again.
All right, so some good thoughts there for the longer term trend that you expect to play out in the energy sector and using weakness and volatility as your friend to accumulate positions. A question we get a lot, Joseph, is when you look at the producers, where they're actually hedged at. So when you look at the muted price of oil and the muted price of nat gas right now, people look at that number that's trading on the futures market, but a lot of these companies are hedged at different prices. So how much do you look at that when you research these companies? How much of that plays into the strength of a company? And is that an advantage or a hindrance in this market?
Well, companies that hedged last year when they were able to hedge, $3.50, $4, do okay. Companies that have access to Dawn, which is a $4 price market in Q2, did well. And right now you can hedge all of 2026 in Canada at over $3. So the problem is the shoulder season. So spring and fall usually is where the price gets weak. The spring issue and the time of and summer is simply because pipelines are being built and you have to shut in other pipelines that are connecting to it. You have facilities, compressor stations and other facilities that are going through maintenance cycles. And so that removes potentially a BCF from the market. And that extra is what drives prices down. And because it doesn't have a home to go to, it can't be moved, out of the province of Alberta or Saskatchewan or BC. And that's really the issue. The key thing for the upside is September that those facility issues and pipeline construction are behind us because they get ready for winter. We'll probably see LNG Canada announce that they're better than 400 million a day. They're moving to a BCF a day. And they may also announce before year end that they're planning to, go for a second train, which would take it to 2 BCF. That would be very bullish for the sector as well.
Why have these LNG terminals been so slow to come online? They're such a catalyst for this sector. So many people are focused on them. There's a lot of money being spent building them, but they just always seem to get delayed.
Well, it's like any big, facility that's 20, $30 billion in construction. You got to go through the tweaks. Both the Americans in the Gulf of Mexico are doing it. We're now seeing it with our first one in Canada. The builders are including Shell, and Shell knows how to build them. So it's not incompetence. It's just the whole birthing pains of getting every piece of equipment to work with other pieces of equipment. And I think that's the issue that they're working on right now. They're talking about getting everything resolved in the coming weeks, so we'll have to wait for announcements. But if we can start hearing them say that we're heading to a BCF by November, because you want that export during the winter time, because demand is going to be flush at that time in Asia, because they have cold weather and they're going to need the gas. They'll pay premium prices, and they might pay $14, $15 an MCF in US, which netting back to the Canadians is a big number. So I think I'd be watching LNG Canada, go to the website and just watch to see when they talk about increases and that the problems that they've had are behind them.
Well, Joseph, this also brings up the larger discussion about having the infrastructure in place to get the gas to these LNG terminals, whether it's in the U.S. or in Canada, and some of the ones planned in Canada in the future. Love to get your thoughts on the infrastructure, the pipeline to get the gas there, but also if there's any thoughts you have on pipelines for oil. Let's talk infrastructure. Let's talk pipelines.
Well, the takeaway in Canada, is there for meeting the U.S. needs right now. We have Alliance Pipeline, you have the TC Energy pipelines. Yes, you could tweak them and add some more volumes. Alliance may talk about doing a second line, and they're going to go and do some work and then go to the E&P companies and see if they want to bid on the line. And if they get enough capacity demand, then they could build another pipeline. But the key one that's going to be is the West Coast. Do all the 6-7 BCF of projects for LNG go through. Remember, 2 of that BCF is just LNG Canada. You have Ellis, the Key Kissimmee line. You've got Cedars. There's a number of projects there that if they all go ahead with announcements, FID announcements, final investment decisions this year, that would be very bullish. And I'm optimistic that we will see that. And the prime minister is going to Europe to try to show them that we're going to be a player. And then of course they're going to, he'll probably go to Asia, the same thing, and say, look, we can be a reliable supplier, and we're closer than the Gulf of Mexico and Australia. So, dealing with us is an advantage and a diversification for your needs. And the security of supply, isn't as much of an issue as bringing it in from the Middle East. So I'm optimistic, but again, is our prime minister just letting us hear what we want to hear, or does he come through with real approvals? And I think that's something I'm hoping at this stage, that it's not just political batter, but reality, and that we do see more Western projects go ahead with First Nations approval.
It's going to be so interesting to see what or if these other trade deals happen outside of the US, because I feel like a lot of countries are feeling like they need to make some of these other trade deals. Who knows if they're going to come to fruition and even what that means for the US, but that's a whole other topic. Joseph, when it comes to the underlying equities, I've actually been pretty impressed at, let's just say, XLE, the large energy ETF. That's holding up much better than the underlying energy prices right now. It's only about 10% off of its recent highs from late last year. Well, energy prices have been fading quite a bit, and even recently it's been mostly trending sideways. So when you're looking at the whole wide options of energy companies, where are the best opportunities? Albeit, I guess we should couch that with, again, we're not at that screaming buy signal that you want.
Yeah. The XLE is at 87.62, down 0.8% today. 52-week high 97.92, 52-week low 74.49. April, of course, it was down there. So it's holding in reasonably well. Remember, Exxon is the biggest weight. Chevron is a big weight. They all have big dividends. So that dividend support is keeping the index up. A lot of producers which don't have dividends, those are the ones that are suffering. But when I go to Canada, I look at the companies in Canada, you've got Freehold Royalties, which pays a 9 cents a month, $1.08 dividend with an 8.2% yield. That can get up to a 10% yield, when the stock gets down to the, below around the 11 level or less. You've got Whitecap Resources with a 7.4 yield, a monthly dividend there. You've got Marin Energy, a company offshore, 30,000 BOE day company, paying 20 cents, a nickel a quarter, 11.6% yield. You go to Alvo Petro, which is Brazil, 9.5% yield. In Play Oil, almost a 10% yield, $1.08 dividend. And then you look at Petrus Resources, 8.2% yield. So there's lots of attractive yields with growth sides where the stock could go up 10, 20%. If I'm right about $75 oil in the winter. So between the dividend and that, you could be looking at 20 to 40% total returns over the next 6 months. The key thing is these stocks might have 10% downside if we go down below 60. And if I'm right about 57 to 59 being the bottom between, late September, late October, then you'll have a chance to buy them at a cheaper price, 10% cheaper, with the strong yields that are stronger than today. And then you have the upside where the stocks could go up 20, 30, 40% in the winter. And so that total return is really exciting. And if you take a look at them and see how good they are, go to the website, see the presentations, look at the webcast, listen to the webcast, and hear the question and answer from the analysts. That's the best way for you to get comfortable with the names. But the bottom line is, if I'm right that we are going to have a multi-year bull market, and that is because demand is going to grow in the third world for the nickel, the aluminum, the copper, all the cobalt, all the rare earths that we're going to need. They're going to use more energy to do that. People want to go from bikes to motorbikes to cars. They want electricity in their homes, running water. And a lot of the third world, billions of people do not have that. And if we want their raw materials, they're going to have to want to buy into it, which means they need a better quality of life. So to me, the increase in the non-OPEC world, or sorry, non-OECD world, will be 7 to 9 million barrels between now and the end of the decade, while in the OECD, we probably will see a 2 or 3 million barrel decline as we use more EVs and as more fuel efficiency comes to bear. And I think that, and, in robo taxis, if that becomes a reality and people don't drive as much with their own vehicles. So to me, the big thing is the international growth in the demand. And if that asserts itself, we will see probably 110, 120 on a regular basis for the WTI in 2028 to 2030. And if there's any disruption in supply, and if you remember in 2008, we went from like 110 to 147. That was because there was no other supply. Demand was strong, inventories were low, and OPEC couldn't bring on any more production. And then, of course, we went into the financial crisis of 08, 09, which, of course, knocked down the economic activity and demand came down. So, right now we've got let's say, a surplus of oil versus demand. By the winter time, that'll switch around. And then the question is, how strong is that switch? How strong is the demand? And how low do inventories go when you have a cold winter? And remember, inventories for natural gas are at the high end of storage. Inventories globally for oil are at the low end of storage.
Well, Joseph, when I listen to you contrast some of the yields and payouts in the Canadian companies and where they may go if we see oil prices drop below 60 into the high 50s, and then think about the XLE, and like you were talking about with Exxon and Chevron, more of the US based companies, there's a lot of pundits, even US pundits that we've brought on the show or I've read their articles, that are getting more and more animated by the discount, the differential between Canadian versus US oil producers. Could you maybe speak to that differential? That a lot of them are pointing to, even people that are big US investors are saying, hey, honestly, the Canadian oil stocks are just totally beat down here. So if they sell off by 10% more, would you be more weighted to Canadian players than US players based on that scenario?
Again, I don't spend time on the US players, so I really don't know the individual evaluations, but American companies, have traded over their PDP, proved, developed, producing. And again, American investors, it's a small weighting in the S&P 500, so they've got to go after the big weights. There's been mergers, which attracts a lot of activity. But in Canada, when you compare our numbers, PDP, discounts to NEV, price to cash flow, price to book value, yields, the size of the inventory, the depth of the inventory. The Montney is bigger than the Permian. And people, are beginning to realize that the reserve life of the Permian is not as long as the Montney and it's shorter. And tier one inventory is declining while we still have a lot of tier one inventory in Canada subject to price. So I'm in the camp that, the Canadian companies, historically, if you go through the cycle, when things get bad in Canada, we have bad politics and there's low prices, the Americans sell out, and you saw CNQ buying people, Ovintiv sold out and became an American company, the former Encana. And so you see them leave. And historically, at markets when they're frothy and when there's a shortage of product, American and other companies come back into Canada and buy a lot of the Canadian industry up. We've seen that in the past. I'll give you an example. Berkeley, Michael Rose has done this twice before. He built up Berkeley, which was a Canadian and some U.S. assets, sold it to an American company, built up Duvernay, a very successful company, sold it to Shell International. So, some of these big boys will come back and they'll be wanting to look at Duvernay. They'll want to be looking, at Tourmaline. They'll want to be looking at Birchcliff. They'll be wanting to look at New Vista. And I think we'll see a significant amount of takeovers that will occur at the end of the decade at premium prices, which means the discount from PDP to 2P will be gone. And that'll mean probably five baggers or more with the takeouts into the end of the decade. So, we're talking, it's, more than midway through 2025, 4.5 years for five baggers. You don't get that often on that kind of an opportunity. And that's why I'm so bullish to take advantage of the corrections and load up the truck and go to. My view is that, and I'll be sending this out to clients, is if we get this next low risk buy signal in late September through late October, I'll be saying it's time to go to a fully invested energy position, depending upon what that is for you as an individual and your risk profile and your portfolio needs.
All right. So maybe just a little bit of patience for the investors in this sector. But look, we will follow up with you when we do get to that table pounding buy opportunity and the stocks that you see as having the best upside. But it does sound like a lot of potential opportunities when the underlying energy prices really turn around and start to build some upward momentum.
Yeah, one more thing I can mention, Corey. We have a conference in October, on October 18th, that you come to, and that Chad's going to be there this year. It's going to have over 40 E&P companies, companies in the royalty sector. Topaz and Freehold are going to be there. A lot of service companies are going to be there. Some mining companies and critical minerals will be there for the energy industry of tomorrow. People can go to the Catch the Energy Conference website, catchtheenergyconference.com, and look at what the program is, see pictures of the prior years, and if they want to come, please sign up and get your tickets, and we'd love to see you at the conference.
All right. If you want even more information on that conference, feel free to email Schachter and myself, and we'll put you in touch with Joseph and his team. Joseph, thanks for taking time with us on this weekend show. And everyone, thanks for tuning in. I hope you all in North America, in the U.S. and Canada, have a great long weekend. Really looking forward to getting the kids back to school and seeing what happens in the back half of this year with markets as everybody comes back to their desks starting at the beginning of the week. We'll see if there are any outside moves or any new trends developing in markets, in metals, or in commodities broadly, all of which you can hear on our website, podcast, YouTube channel, and through our Substack page. Just search the KE Report and tune in on a daily basis. Everyone, thanks for tuning in this weekend. Hope you have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.